Today, Australia's recession chances in charts. Hi again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news. It's Friday, and Tarric Brooker is with me once again. Hi, Tarric. How are you going?
Not too bad, Martin. How are you, mate?
I'm pretty good. It's Friday. Always good on a Friday.
Yeah, it is, and there's plenty of data for us to go through, and plenty of charts for the viewers. So I'm looking forward to it as always.
Absolutely. And I will just give people a quick update. The studio's coming along, so I don't have everything working now, but the good news is we're actually now starting to take a shape like a studio rather than actually where we were previously, which was a very, very empty room with nothing on the bookshelves. But it is taking a long time to put the studio together. It's a bit like trying to get the inflation battle down, right? It always takes longer than you think.
Yeah, I think there's a bit of a difference in terms of the timescale there, though, mate. A couple of weeks versus, well, maybe a couple of years.
It is really interesting, isn't it? And I was watching the Bank of England over the last 24, 48 hours. So one, they had the inflation higher than expected. They then went 0.5 up to 5% now. But the most fascinating thing about the discussion in the UK is suddenly everyone's blaming the supermarkets and all the businesses for price gouging. How funny is that?
It's interesting, isn't it? And then you've got all the banks being called to number 10 to, explain themselves and for them to help all the borrowers who are now finding themselves in trouble through higher rates. So it's interesting the way that different corporations get scapegoated and asked to make all these various sacrifices, even though in a lot of cases their costs are rising too.
Absolutely. And it's fascinating to me that they blame the central bankers, so it's the central bankers' fault. They then blame the corporations for price gouging, or they basically are looking for all sorts of excuses. Okay, it was Ukraine. Okay, it was power. Somewhere though, there's a question about, okay, who owns the policy in the first place?
No, absolutely, and that's something that I've been talking about for a while now. Around the world, politicians and commentators are just, a lot of the time, it's never the politician's fault.
Yeah.
It's always the central banker. It's Powell's fault. It's Lagarde's fault. It's Putin's fault. It's Xi's fault and China's fault, but it's never the politician's fault. And I think that's something that's kind of amazing here in Australia. The Morrison government committed to over $500 billion worth of stimulus at a federal level. And the overwhelming majority of that was supported by Anthony Albanese and the Labor Party. And then you also had even more stimulus at a state and territory level. Yet when we talk about inflation, it's very rare that you hear people talking about how they just spent money like drunken sailors. And I will say, even Phil Lowe recently has said, well, there was a fiscal side of things too, guys.
Well, he did actually admit, didn't he, that they did take rates too low, but they were, trying to ensure that the economy didn't crash, which I suppose the other side of COVID, you could argue a bit. But the thing that I always come back to is I can't help but think of the various politicians who were encouraging people through the COVID cycle to go buy property, ultra low interest rates, great time to buy property. I can remember certain politicians almost giving financial advice.
Well, it doesn't count as financial advice, though, does it? Because even though it is financial advice by, if you take leave of this country, but when it comes to the law, no, it's not. It's not financial advice, and I find that quite funny here in Australia. Housing is an investment, but it's also not an investment when it comes to the financial advice laws, which is just ridiculous. I find it funny that that you and I, if we were to get on here and recommend a high interest savings account, without a financial services license, we could find ourselves in quite a bit of trouble. Yeah. But if we were to get up here and tell someone to go buy an off the plan apartment in one of Edwin's favorite developments, then it would be a completely different story.
Yeah, well, there's property and then there's real life, right? The two, ne'er the twain shall meet. But of course, the discussion in Australia is the R word, right? Recession. Is recession happening? And I guess, there's a formal definition of recession, which is 2 negative quarters of GDP. But then there's also the real on the ground feel recession meaning that people are struggling, et cetera, et cetera. And we definitely have the latter, even if we don't necessarily have the former. But all the discussion seems to me to be heading towards real recession as well, potentially.
Well, it's certainly looking that way. And I mean, if we go back a few months to when that there was that freedom of information request of the RBA, and they talked about the possibility of a recession, and if the US went into recession, I believe their number was around about 75% chance that Australia would follow on the modelling that they had at the time. Now you've got CBA and HSBC have both come out and basically said that a recession is now a coin flip. And I personally, I'm a little bit more pessimistic than that. I still think it's possible Australia could avoid a recession, but I think it's going to need external factors to do so at this point. And, I mean, the economy just really isn't growing that great to begin with. And we still haven't started the bulk of the roll-off of fixed rate loans, and there's still more rate rises to come.
Yeah, and two other factors, of course, the migration numbers are very high, which means, of course, that you are inflating the overall economy. So at one level, you could have escaped a recession at the top line level because of extra people, but the per capita numbers, which are probably even more negative, is perhaps a better indicator. The second is, of course, last time around 2007, 2008, 2009, China basically saved us. And the question is China likely to throw a lot of stimulus at its own economy? And do we benefit from that in Australia? And I guess those are the two big factors that you have to factor in when you think about whether this recessionary talk is scaremongering or whether it's potentially real.
Yeah, I concur, and I think it's just worth noting on the migration factor that much of that was front loaded into the first half of this year, because you had the returning students, you had this huge surge in migration in temporary visa holder numbers, which we've seen in the Department of Home Affairs data. So one wonders if with the seasonal way that it impacts the economy at this level, because there's so much of it, if we're going to see a bit more downside later on in the year, particularly given the fact that the economy is already, well, in all likelihood, in a recession in per capita terms, and in top line terms, it's not growing that much better either.
Yeah, absolutely. And of course, the numbers are always looking backwards rather than predicting forwards. And I find it quite interesting that the various forecasters have become more and more negative. As you say, CBA and a few others are saying it's a coin toss. It could happen. They don't tend necessarily to take the most bearish case. So if they're starting to talk about it, then we should probably look at the evidence in more detail and try and figure out what the tea leaves are saying.
Yeah, I mean, I think that's the way you've got to approach it, because I mean, realistically, they're not just going to talk the economy down. It's like there is a 100% chance we're going to have a recession. That's not really what you want to do to your multi-billion-dollar mortgage book. But I think that realistically, it's going to be hard for Australia to avoid a recession based on domestic factors, just because there are just so many headwinds. And I mean, I honestly just think it's a little bit interesting that people talked about Australia avoiding a recession like it was a likely scenario, or in say like the last year, for example, since we've seen the RBA raise interest rates, because we have seen the largest tightening of monetary policy in relative terms in Australian history by a fairly significant margin. And not only that, but the largest prior tightening was between 2002 and 2008. And that took place over 6 years. This tightening has been larger than that in relative terms, yet it's occurred over about 13 months. So, you can, as many economists will tell you, it's all about the rate of change, and ripping that much cash out of the economy is going to have an impact.
Absolutely right. And of course, the other issue here is that not all households are equally being impacted by what's going on at the moment. So, only a third of them have mortgages, and of those, maybe half of the mortgages are, relatively small and relatively benign. But there's another chunk there that's going to have a real problem. But incomes aren't growing particularly fast. In fact, in real terms, still going backwards. And the prospect forward for inflation, given the fact there are more power bills coming, I think 1 July, the 24% increase in power and for some people. There's a lot of factors sort of still to work through. But I do come back to what central banks, I take Adrian Orr in New Zealand. Adrian Orr some months ago said, we're going to have to create a recession in New Zealand to actually deal with this inflationary problem. We've now got people in the UK saying, we've got to have a recession to be able to actually shake the inflation issue out. Of course, in the US, Powell is still saying, I can see a path where, in fact, we can avoid a recession. Magically, we can keep unemployment low and we can deal with inflation. So there's a question about, is that a magic bubble, or is it is it real? And of course, some of the Eurozone is in recession at the moment already. So the R word is definitely very current. I think that Australia is going to have a really tough time over the next couple of years, and the politicians, of course, will do everything to say it's not their problem. And they'll throw some money at it, but they can't throw much money at it, because if they do, it's going to make inflation even worse.
I think that's a big, a really good point about, where Australia stands relative to its peers. Because, you look at, say, for example, say the US. The US core inflation has come down, not to a huge degree, but it has come down, and it will come down on base effects due to things like, say, like used cars. Because used cars prices are going to fall, fairly significantly as the US economy deteriorates. That is going to drag down US inflation. The problem for Australia is that as our inflation drivers start to run out of gas, say, for example, the cost of buying a new home, which is a fairly sizable component of our CPI, as that peaked, a couple of quarters ago, and it's continuing to fall. But as that falls, rents are rising and electricity is rising. So we're trading one driver for another. And that's really the problem for Australia going forward. I did a little bit of an analysis last year based on, I believe it was around about 10 or 11% rental growth and a 35% increase in household electricity and gas prices. Now we're looking at about 25 to 35 here. It depends on your individual circumstances, but let's call it 25. That is going to add around about 1.8% to inflation between rents and electricity and gas. That's going to add about 1.8% to inflation by themselves without anything else. And that is based on the relatively benign scenario of 10 to 11% rental inflation. Now, if you get into the SQM range of their number, I believe recently was about 18% in rental inflation. If that feeds into the CPI, at that point, you've very nearly consumed the entire 2 to 3% CPI target with the inflation from electricity, gas, and rents alone. And that's only, ballpark around about 10% of the overall inflation basket. So you'd better damn well hope the entirety of the rest of the economy is in deflation for that not to keep interest rates high. And that, I think, is the problem. We could see deflation in all manner of different elements of the CPI, but as long as you've got those inflationary drivers baked in, even relatively benign inflation outside of those will keep the CPI uncomfortably high for the RBA, at least until they panic and want to save the housing market.
I wish they will at some point. The other thing, of course, food inflation is still well above, long-term trends, right? So although it's come back a little, food inflation is still there too. And it's worth thinking about the way that energy prices propagate higher prices into many other sectors. And of course, the other factor is wages growth is up high, and the Fair Work Commission, basically help the low paid, but in doing so, there could be an inflationary factor there, and the higher wages again flows through. Some of the services inflation is looking pretty strong too. So the chances of there being enough deflationary factors elsewhere in the economy to offset those rises that we know are coming is the key, and I'm not sure that there are.
No, and I think it's also just worth noting that even if you look at the sort of largest deflationary move since probably potentially the Great Depression, maybe the Korean War, you need to really look closely into some of the quarter-on-quarter figures. But if you look at the largest one, which was the global financial crisis, that didn't actually kill, say, trimmed mean inflation in Australia to within the RBA target within the first year. So, you had the GFC happen, subprime, Lehman, all this stuff. Aussie inflation was still above target a year later. Now, the only reason broader inflation was driven down so quickly is because the cost of financial services basically collapsed overnight, and that distorted, and you obviously saw the collapse in commodity prices. So unless you're looking at an absolutely disastrous scenario where something like that is repeated, which is let's just say a rather significant problem in and of itself, it's going to be hard to kill inflation quickly. And I think that, that's really the main sort of message going forward. Yes, we are going to have some easy times in terms of reducing inflation due to base effects and due to just the fact that we saw these huge, big increases. But actually getting it back to target is a much, much more difficult task.
Absolutely right. Keeping it there once it's down as well, of course, the other question. Now, you actually put out an invite on Twitter ahead of this to say, hey, what you're interested in seeing. And I know you got quite a lot of responses. So
yes, I do. So
you have a fair few charts.
Yes, we do have some. We do have some charts. We're going to start with the charts, and we'll get to the questions if we have time. If we don't have time, I do apologize. We will try and get to your question at some point in the next couple of shows, but there was a lot. All right, people, as usual, the charts are available. I'll get Martin to put a link in the description. And if you would like to support my work, you can do so at avicom.substack.com. It may or may not be tax deductible. I have no idea, but it's a financy economics type newsletter. Do your own research, and any support would be appreciated before the end of financial year, folks. But anyway, enough self-promotion.
And I just want to say, Tarric, that chart, that cartoon is brilliant, right? The AI hype, right? And it's just worth reflecting on it. We've got a chart on this later, but actually, if you look at the the main indices, if you strip out the AI hype stocks, the indices are not performing anything like what people think they are. So it's all about a little side show.
Yeah. And if they're not careful, it's all going to end in tears, as it has so many times before. I mean, Nvidia is trading at a lot higher price to sales ratio now than Cisco was back in 2000, and that was when one of their executives famously penned that note, basically saying these valuations are not justified because, frankly, we would need to pay you all of our earnings and not do any R&D or any capex or anything else, or pay our employees. So it's interesting times.
Absolutely right. Yeah, .com bubble of 1999. Here we come again. Anyway, inflation, deflation.
Yes.
What's going on?
Let's get into it. Okay. Now, I put out an article, which I'll get Martin to put in the description as well, on basically the chances of Australia having a recession in a couple of charts, and one of them was the relative increase in mortgage interest repayments. Now, a few people made comment on the previous chart and said, well, what about how rates have evolved since pre-COVID? Which I think was a good point, particularly for those borrowers who took on those larger loans in 2018, 2019. And basically, the current rise in variable mortgage rates is twice as large as it was in the previous largest cycle, which was between 2002 and 2008, as I previously mentioned. But even if we look purely at pre-COVID to now, mortgage interest repayments are still up 77%, which is still a record relative to the way it was before. Now, I've also added at the bottom there what it's like for someone who's on the average expiring fixed rate mortgage, who's someone who took out a loan in, say, the middle of 2021, who's now having their 2-year fixed rate expire now. And their mortgage rates are going to rise. Their mortgage interest repayments are going to rise over 200% based on today's rates. And that is obviously not taking into account potential further rises in rates. So that's a lot of cash that's going to be coming out of the economy and paid on mortgages.
Yeah, and it's worth saying, of course, as I said earlier on, only roughly a third of people have a mortgage. So, others are paying rent, have a different problem, or if they own their property outright, don't have a mortgage, therefore not hit. But this proportion of people who are actually being hit with significant rises is enough to potentially, from a marginal perspective, tip the overall economy over.
Yeah, and I think that you make a good point that we can look at this through two. Well, you can look at it through many different lenses, but the main two that are generally seen through this particular issue is that how is this going to impact the housing market? Now, you and I have discussed that at length in the last couple of shows, and basically it's something that is going to impact the housing market, but it's going to take time. It's going to take, a year, 2 years, potentially, before it, really starts to feed in. But in the here and now, avoiding those issues in the housing market is going to hit the economy, because these people are going to have to, do whatever it is that they have to do, reduce whatever spending they have to reduce in order to keep their property, and in order to not end up in serious arrears or default. So that is a separate thing. So I think that is really something that's a little bit overlooked in the whole mortgage cliff scenario. Yes, it might not be, it won't be as devastating for the property market in the short term as some of the other media articles have suggested it will, but it is going to hit the economy in terms of all that extra cash being dedicated towards mortgages and not household spending. Although it very much depends on your perspective as to how prepared people are for this. And that raises an interesting question for you, Martin. Like, have you seen any preparation in your data to a significant degree by people with fixed rate mortgages?
So I think, looking at my surveys, about half of those with a fixed rate problem ahead are already trying to make adjustments. So, for example, by paying more than the minimum now to get used to it, or indeed to start to explore whether they can refinance and recycle their mortgage ahead of time to try and actually avoid some of the higher rates later. So I think roughly half are actually probably not greatly prepared, but somewhat prepared. The other half, they're just head in the sand. So they don't actually see it as a problem yet, or maybe it's rabbits in the headlights. So what that means is that those people are just waiting, for it to hit, and then they're going to respond. And unfortunately, from my analysis, those in situations where their cash flows are more extreme, sometimes where their education levels are lower, and sometimes where they've got multiple but part-time jobs, are all factors that tend to suggest that they are more likely to be in the latter camp rather than the former camp, which means they're going to be smashed.
Are the group that are preparing, do they tend to have older loans by any chance? Look, okay, yeah, yes. I was just wondering because
older loans and more income and more financially sophisticated.
Okay, so I mean, I don't think I'd be wrong in then concluding that to say that the bulk a vast bulk of the debt is probably held by the people who are taking the ostrich option rather than because Correct. They do have the older, smaller loans.
Yeah. So the ostrich is very much aligned to recent first-time buyers, to younger people out on the urban fringe or in some regional areas. Those people have had cash flow pressures, not just in the last few months, but over the last 2 or 3 years. So I was tracking mortgage stress, and mortgage stress has been rising quite considerably over recent times. A lot of these people were in stress over the last 1 or 2 years. So they've got a long-term problem and therefore less ability to be able to forward pay their mortgage or figure out what to do, or indeed are just not interested or engaged around the issue. I'm too busy perhaps trying to feed the kids and do everything else. They're the ones that are going to actually find that this nightmare suddenly emerges. And of course, for many of them, it's going to be a really tough work. What do they do? Where do they go? How do they deal with it? Now, the banks, of course, are actually trying to be flexible. But if you look carefully, their flexibility is more aligned at those who have equity buffers and have cash flow and haven't missed a payment. If you're in this latter category, the ostrich category, some of those, the banks are much less willing to be flexible.
Yeah, I think that's really, something that's worth emphasizing, that if you look at say, for example, CBA's criteria to be able to qualify for the reduced 1% buffer rather than the normal 3% buffer in order to refinance, you need to have over 80%. You need to, have under 80% loan to value. You need to, like you said, not miss the payment. You need to be in good standing with the bank. There's a bunch of other stuff that you need to do to qualify. And to me, it seems more like a nice headline and something for their PR team to point at, rather than the sort of the way it's been perceived in certain circles of the property sector, where it's like, oh, the banks are going to save everyone. They're going to save everyone from all the from evil APRA and the mortgage prison and blah blah blah. And to a degree, sure, absolutely, but it's not the sort of catch-all save everyone thing that it's sort of being made out to be.
I think that's absolutely right. And of course, here in the UK, where the same discussion is going on, people also make the observation that if you actually make it easier for people, then what you're doing is fighting against the monetary policy, which is meant to actually make it hard for people. It's meant to tighten down spending. It's meant to make it difficult. So in a way, if you get all this relief coming via the banks being generous, what you're doing is fighting against the monetary policy, which means interest rates have to go even higher.
Yeah, exactly. I mean, like if all these people are switching off, say for example, considering how much rates have risen, there are people who are switching off from principal and interest to interest only and paying roughly the same amount of money as they were prior to, say for example, their fixed rate expiring. So, they've been given maybe a year or a couple of years to do that. But as you say, you've now completely, unless that household is particularly prudent and part of that other group you were talking about, you've just completely erased the impact of monetary policy on that household. So as you say, if it happens enough, then higher rates.
That's the actual issue. Yeah, it really does. it basically takes out the teeth from monetary policy if in fact you get too much support. And the same with rental support, or the same with price controls, anything like that cuts across what the central banks are trying to do. So there is a limit to how much that can be done.
Yeah, in theory. Now, whether or not the government does something stupid to buy an election, I'm sure
they'll do
we'll
something
see.
stupid. Plenty of evidence of that in recent times. So yeah, because of course politicians are worried about being re-elected, and politicians are worried about saving face and all those things, rather than some of the other dimensions, and that then puts potentially them in contention with central banks and central bankers, right? So all of those things are in play at the moment.
No, I agree. Now, this is a good chart from Morgan Stanley that just shows when these mortgages are expiring and when the bulk of them are expiring, which is basically, well, it's now. It's the largest pool of expiring loans is May, June, but there's basically a large block of loans over most of the remainder of this year when the bulk of these loans are going to be expiring, around about 800,000, I'm told, during 2023. So yeah, that's a lot of spending that's going to be taken out of the economy over time. So yeah, it's going to be an interesting one.
And of course, remember that the propagation of higher rates takes 2 to 3 months to come through for those on variable rates already. So as well as the fixed rate maturity issue, we've also got the ongoing grind from those rate rises that have already come through. And of course, the RBA is saying we're probably going to have to go even higher. And of course, the money markets are actually expecting now higher rates for longer. If you look at the 1 month forwards in terms of the mortgage, the cash rate, it's now above 4% in November 2025. So it's much higher than before the RBA's last outing.
Yeah, I think the game has really been changed globally over the last, call it 4 to 6 weeks.
Yep.
You've seen the Bank of England hawk up the Bank of Canada. Even our own RBA. You've seen them surprise with a rate hike and then force all the banks to scramble and readjust their forecasts and raise them higher. And it's just amazing how quickly it evolves. I mean, to you and I, we were always talking about that potentially happening anyway, but it's amazing just watching it evolve. And it's going to be really interesting to see how sort of consumers, and how they evolve with all of this, because, a lot of the data that we do have on that is very much looking in the rearview mirror. And some other indicators, say, for example, ANZ's Consumer Confidence Index, which we'll get to in a moment, it's not really all that helpful to know that consumer confidence has collapsed. Okay, it's collapsed, but what we're seeing in a lot of other sectors of the economy is not a collapse. Unemployment isn't rising by 0.3, 0.4% like it was last time consumer confidence was this low. So a lot of indicators have lost their utility in terms of giving us an accurate picture of the economy.
Yeah, but I think the most significant event this week was Michelle Bullock's comments regarding unemployment. So she said, we need to see unemployment up at 4 or 4.5% to really get inflation under control. So, she's of course at the RBA, and the fact that they're talking about an expectation of higher unemployment, I think, is a remarkable turn of events.
it does sort of borrow a bit of a page from the book of the Bank of New Zealand with the sort of frank, the Reserve Bank of New Zealand, which, it gives you a little bit more clarity about the reality of the situation rather
Mm.
than just, narrow paths and puppy dogs and fairy tales. It's just like, no, we need to do this. And realistically, it's very, very difficult to only raise unemployment a little bit. If you look at, say, for example, the history of US unemployment, where there's a lot more, in-depth data and a lot more, analysis undertaken into that. If you raise the unemployment rate by 1%, chances are it's going to rise by a hell of a lot more. And it's very difficult, especially in an economy like Australia's that has the excesses that it has in it. I mean, like I was reading an old journal article about the 1990s, the 1990 recession just earlier today, and they talked about how it was a recession that occurred because of the excesses of the 1980s. And I can't help but look at that and think, oh, the excesses of the 1980s. Yeah, okay. So, with the 40%, household debt to GDP ratio and the 48% household debt to disposable income ratio, which is now 211%. That was an excess. And I think about, potentially having the excesses, washed out of the economy this time. And well, I think it's going to be quite a lot more challenging. If that were to fully occur, then I think it's going to be quite a lot more challenging than a 4% unemployment rate.
Right. And of course, the real risk factor here is that the property sector is such a large proportion of the economy. And that's, of course, supporting, financial stability in the banks, et cetera, et cetera. So the question is, at what point do the cracks get so deep that they have to turn turtle, or will they actually allow it to grind through and shake it all out? I don't know. I mean, I still think that there's going to be a change of strategy sometime down the track, but I suspect they'll do a lot more damage to the economy and to households and businesses first.
Yeah, I would generally concur with that. I mean, I think that realistically, we've maybe got, don't, sort of, don't take this as financial advice, but I realistically think that they've got around about a year on the clock in terms of being able to actually impose this on the economy and not really, really break something. I think they're going to break stuff, but not something that's going to be so horrifically bad that it's really going to smash the economy into a very, very deep recession. Mostly because things are still relatively okay-ish here. It's going to take time for the labor market to fall apart, and realistically, so retail sales are falling and all this other sort of stuff. It doesn't really matter overall. Like we might even have a recession, and it might in headline terms, but it might not actually be so bad. I mean, New Zealand's had a recession already, in a recession in those terms, and well, that doesn't look so bad.
Well, the housing market there, of course, has dropped, whereas here it's not. Well, it's
Well,
dropped
like I
more
said, it doesn't look so bad.
for now.
Yeah, exactly. I mean, everyone runs out of luck eventually, but in a way,
Yeah.
them taking the recession now is, arguably the better option. Taking it
Yeah.
while things are still good, and that way
Yeah.
they'll be on the up while everyone else is still on the down.
Yeah.
All right. Now, I think yeah, it's yeah. I think this one thing that I find interesting about this chart is that it shows that consumer confidence has absolutely collapsed. We are at based on the 4-week moving average, we are at the lowest level since the depths, the very lows of the 1990 to 1991 recession. But the thing that I find interesting is that people are not panicking. I find that quite fascinating. No one's going out and being like, "Oh crap!" Not no one, but a relatively small proportion of people are going out and going, "Oh crap! I've got to sell my house. There's going to be a recession and things are really, really bad." And blah blah blah. We're not seeing that same panic that has historically accompanied this type of collapsing confidence levels. Like if you look at the US, say for example, when their consumer confidence collapsed, you know, in the run up and then during the early months of the financial crisis. Now I'm talking pre-Lehman, before it really, really fell off a cliff. But there just isn't that level of concern and level of panic. And, there's just sort of this vague idea that things are just going to get better and be okay because eventually the government or the RBA will step in.
Yeah, absolutely. And the point about confidence, of course, is it's rearward looking rather than forward looking, really, isn't it? So, what are the forward projections? What are the signals in terms of forward looking? Because the prospects are probably more negative rather than positive. So, in other words, this may not be the bottom of the cycle.
No, I mean, if things deteriorate further, it's going to go even lower. But I think I think that we are just sitting in an unprecedented situation. Now, that word has really been overused over the last couple of years, but it also happens to be true.
Yeah.
Because, you know what, I'm just going to go on to the next slide. No, not the next, this one.
Mm.
This is what real wages look like from 2000. The top blue line is 2003 to 2008, and the yellow line is 2018 until the latest data, so 2023. Now, this is something that you and I have actually talked quite a lot about over time, Martin, that how rising wages insulated people from rising rates during that period in the mid to late 2000s. And it also helped insulate them from the downturn of the global financial crisis. Now, while we didn't have a recession, there still was a fairly significant downturn, and we still did see a significant upturn in unemployment. But this time, household incomes in real terms have already got smashed, and they're going to continue to get smashed until we get inflation under control or wages rise sufficiently. So I think it's quite interesting that people are so down on the economy, and I think that this is one of the reasons why.
Yeah, well, it's clear that in real terms, wages have gone completely the wrong way. And, I look at the data in cash flow terms, and, people are definitely under the gun. Also, it's worth pointing out, I think, that we've got a rise in multiple jobs. We've got a rise of people working more hours to try and get by, and yet real wages are still going backwards.
Yeah. Yeah, I think that's a structural issue in the economy that really needs to be addressed, but frankly probably won't be. And things look.
And just to add, of course, the migration includes a lot of people who are actually prepared to work for less. So it actually puts downward pressure on real wages rather than anything else.
Yeah, on that point, I would just add that I think is going to be where we're going to see the first real weakness in the Australian labour market, in the youth unemployment rate, because that is going to be where people get pushed out first, because that's where we've seen the largest expansion of the labour force. So I think that it's going to be a challenging road ahead in that regard, because we don't like this. I think is a good example of why it is going to be so difficult to avoid a recession. Now, we did avoid it narrowly in 2008, and part of that was this strong growth in real household incomes. But this time, we're ripping it out instead, and it's challenging to see how we manage to avoid it, unless, of course, we magically see some sort of, huge boomers to the rescue level spending from somewhere, and that just saves the day, like it has admittedly so far this year.
Yeah, well, boomers are still cashed up. All the charts show that. And I was talking to somebody the other day who's in the discretionary sector of the retail, and they're saying they're still getting quite a lot of people coming in and buying big. But of course, it's a very particular profile of people. And is that really sufficient? Other point, of course, just on China again, China's youth unemployment is about 20% at the moment. And that suggests to me that they've got a different set of issues relative to where they were last time around. So their response cycle through low growth might be different this time relative to just build more stuff and import more things, which means that we might not see the same benefit from what China does flowing into the Australian economy.
No, that's a really, really good point. I mean, realistically, they need to be targeting these new graduates and basically providing support for the industries that they're looking to get into, or industries that are considered of socially equivalent standing, shall we say. I mean, it's very difficult to tell someone who's qualified as say a tech engineer, like I say, like a computer science engineer, or a teaching or someone who has a teaching degree. It's very difficult to tell them, no, you can't work in the field that you've chosen, or anything equivalent. You've got to go work on a farm, or you've got to go work on a building site, or in a factory, or whatever it is. And I think that that's going to be one of the challenges that China's really going to have this time, because they can't just throw money at the problem like they used to. And it's also the fact that, 15 years have passed. The expectations of the Chinese populace are very, very different. And the sort of, shall we say, the hardship profile in terms of how it's approached is very different to the way it was then.
Very good point, Tarek. And I think that some of these factors are not obvious to many people who are saying we'll get a replay of 2007, 2009. I think this time it could well be different.
Indeed, and I would also just add that iron ore isn't $20 a ton anymore.
Yes.
So like in sort of 2007, iron ore was $20 a ton, and then it went up to well over $100 a ton over the next couple of years. For that then to happen with the equivalent today, iron ore would need to go up to sort of something like $400 or $500 a ton.
Yep.
Now, good luck with that. So, admittedly, there's obviously a lot more. So it's probably more like say like 300-ish, maybe 250, 300 over a sustained period. But that's a big ask. And, that would take a fairly sizable increase in demand that I don't think is going to be there.
No, I tend to agree. I think this time the parameters are somewhat different. So we'll watch it. We'll watch and wait, I guess. Indeed.
And we'll just go back to that other chart. Now, this is from Shane Oliver at AMP. And I just thought it would be really interesting just because there's this whole debate about, and discussion about 17% interest rates. And it's this hot button generational issue. But that is the little black circle there.
Yeah.
That is the increase in mortgage repayments that managed to smash the economy into a recession in 1990. Now, then you look at the right and you look at the increase in interest repayments now. Now, this is relative to incomes. So it's a hell of a lot bigger. It's a hell of a lot bigger hit. And we're going to see, not only this is a 4.1% cash rate, and the consensus is higher, at least somewhat. And so we're going to see all of this cash sucked out of the economy in record time, and it's going to be quite challenging.
And I'll just say that back in the 80s, the peak rate didn't hang around for that long. They actually cut rates quite quickly. Whereas this time, knowing where we are, the expectation is that those rates will be higher for longer. And, they might come back a bit, but they're not going to come back to 0.1 or 1%. So in other words, there is still an interest rate shock in the system, even if rates do come back a bit.
Yeah, no, you're absolutely right. And if you go back, say for example, like you said, rates were cut from 17% to 4.75% in a little over 3 years.
Yep.
Now, that was the biggest free kick for Australian mortgage holders in history. Because, they saw that their mortgage repayments absolutely plummet, which helped power the economy out of the 90s recession. So if we do have a recession and inflation does remain, elevated and too high for the RBA's liking, we're not going to see that same, as you say, we're not going to see that same windfall this time. That's provided they don't do something stupid, but, which admittedly can't be ruled out.
Oh, never been thought of.
No. Okay, one of the reasons why Australia stayed out of recession in 2008, 2009 was this chart in the blue. The fact that the population grew by well over 2%. And it's kind of hard to have a recession when the population is growing at 2%, because it means the economy needs to contract by more than that. Now, in per capita terms, Australia did have a recession, a fairly challenging one for quite a few people. But in headline terms, and well, that's what matters in certain circles, particularly to the politicians, we didn't have a recession. This time, population growth is around about 2%. So once again, it's very challenging to have a recession under those conditions. And frankly, if you're having a recession when the population is growing by that much, things are pretty bad.
Right. But again, you're defining it in aggregate GDP terms, right? Rather than GDP per capita.
Of course. Well, that's what I meant by, if we were to have a recession under those circumstances in headline terms, things would be very, very challenging, because we're already seeing the economy contract in per capita terms. And, that is, I would also just add a little interesting fact that is with Australia importing the highest number of high net worth migrants of any country on the face of the planet. And I'm not saying this is not per capita, this is in nominal terms.
Yeah.
You know, Australia has imported over the last 12 months more than 5,000 high net worth individuals. Now, you'd think that that would be enough to power the economy, that, you know, that with importing so many wealthy people, that things would be getting better. But unfortunately, for the rest of us, for a lot of people, things are getting quite a lot worse at a rate that is faster than other people are coming in and spending their money and making it better.
Yeah, and Edwin and I discussed the other day, you know, some of these people who come in cashed up, then go and buy property immediately. And that's putting, you know, another firecracker under some property in some areas, simply because they have the money and are prepared to pay the prices.
Indeed, indeed. Now, this is from the NAB Business Survey, and it basically just shows that despite the fact that prices are coming down, the actual costs in terms of purchase costs and labor costs are actually bouncing at an uncomfortably high level. Now, it's worth noting that this is not it's not an annual chart, it's a quarterly chart. And, well, let's just say that labor costs and purchase costs rising at more than 2% per quarter is uncomfortably high for businesses, which is going to impact profitability, which is going to impact the economy, and eventually, I imagine, the labor market.
And it goes back to what I said. One of the factors, you know, in this inflationary story is to what extent are businesses putting their prices up because they've got no choice but to do it, and to what extent are they doing it because they can gouge a bit on the way through. And you know, greedflation, as some people are talking about it. So this is a very worrying signal, and it's interesting that there are a few other charts around the world showing a somewhat similar story, where inflation came down from its peak, but it started to turn and go up again, just as in the UK. So things are not going necessarily one way.
No, and that, as you say, that just illustrates the challenge of getting back to, that illustrates the challenge of getting back to inflation targets. And that was something they mentioned in today's Judo Bank Australian Services PMI, where they talked about the, you know, price pressures becoming entrenched and, you know, remaining even though broader conditions were deteriorating, and that's a problem.
Yeah, absolutely right.
Classic stagflation. Now, I'm not generally a huge fan of inflation expectations, because I think that too often they can be distorted by energy costs, particularly petrol. But, well, the RBA and central banks more broadly are fans of inflation expectation charts and, you know, the underlying thing that they represent. And this, I think, shows nicely that every time inflation expectations start coming off a bit, they bounce from that uncomfortably high level. So I think that that's really gonna be a problem, because if we do see this entrenched on over the long term, and it does start getting into the psyche of people in a meaningful way, which admittedly is a big if, particularly in Australia, then we could continue to see that upward pressure on prices and upward pressure on wages in industries and for individuals who do have the leverage to be able to press those price increases or wage increases.
Absolutely right. And it's interesting if you correlate the expectations with the confidence, right? You know, clearly more people are now worried about inflation being sticky and staying high and the consequences on their households. And I see that in my surveys too. So unfortunately, it's hitting people, and they're now beginning to worry about what's happening ahead. And with all the talk about higher rates and you know, the mortgage pain, et cetera, maybe it's not surprising that some people are choosing to hunker down and spend less and try and lay some, you know, get out of jail cards. But as I said earlier on, there are still a lot of people who are caught in this and don't have any real sense of what to do and how to tackle it.
Yeah, no, I think you make a good point there, because one of the issues is how inflation is approached from a statistical perspective, which is the central bank perspective, and how it's approached by people, you know, the everyday household. Because, you know, it's all well and good, you know, for, let's just say hypothetically we do manage to get back to the inflation target within the next 12 months. It's all well and good for the RBA to come out and say, we've got inflation back to target. It's 2%, aren't we fantastic? But from the perspective of people, the man or woman on the street, prices are still high.
Yep.
Their wages, their purchasing power is still gone from where it was before. And I think that is going to be a really challenging thing for consumers and for the RBA and for policymakers to confront, in the probably decade or two that it's going to take for us to get that that purchasing power and that real wages growth back.
Yeah, and one way of thinking about inflation is it's a hidden tax, right? Because effectively the value of the money that you're earning, the value of the money that you've got saved, goes down as the cost of goods goes up. And that's a pretty intractable problem. And what it means is that people just have less capacity to do the things that they want, and have to spend more on the non-discretionary items rather than the discretionary items we saw from the recent data. And so this is a bit of a long, winding road. And at the moment, I don't see an exit.
No, not in the short term. I concur on that. Now, as I said earlier about the effect of baked in inflation, I made this chart towards the end of last year, and basically it shows what inflation would have looked like over the past decade if you were to see the level of rent increases seen in CoreLogic and SQM's data, and a 35% increase in electricity and gas prices. Now, even looking at some of the more periods of when inflation was depressed, say, for example, 2016 or the start of 2019, inflation very rarely got back below 3%. And if inflation is bouncing around like that, and that's the benign scenario, the CoreLogic scenario, not the SQM scenario just blows everything out of the water. But even if we take the more benign scenario, it's very, very challenging to get things under control. And this is with low inflation in everything else. If there's even moderate inflation in everything else, then it's going to be a hell of a lot higher. So I think, unless we do have a really challenging time, it is going to be difficult to kill inflation to the level that the RBA would like.
Yeah. Well, their target is 2 to 3%. There's some debate about whether they're going to change the target. I suspect not. They might change the governor, but even if they do change the governor, they probably won't change the target.
No, I don't. They are not going to unilaterally change the target. No. There will need to be a consensus amongst large central banks to change the target, and I don't really see there being a need for that anytime soon. And while people say, this country or that country can't take higher rates, say the US, they can take higher rates for a while. They can probably take higher rates for longer than most people, mostly because, say, for example, from the household sector perspective, the vast majority of their mortgages are fixed. So it's not really the blow that it would be to, say, Australia or Britain or any number of other countries that has variable or short-term fixed rate loans. So it can stay higher for longer than people would think is comfortable. And there's also the geopolitical side of things as well. Does the US turn around and go, well, interest rates are a nice little weapon to use against our rivals, and keeping rates higher sucks in all this extra capital into our market and into our country. So why don't we do that? So I think that there's a lot more at play in the world of interest rates than just the normal basics.
I think that's a very important concept, the idea that inflation itself is a weapon, and it's a geopolitical weapon as well as an economic one. And I think that's probably something which people should come to understand, and probably will need to come to understand ahead, because there are consequences in terms of exchange rates. There are consequences in terms of capital flows. Of course, the US is trying to restock the Treasury larder at the moment, so they're going to be issuing a lot of Treasury. And the question is, well, who's going to buy them, and what is that going to do to the exchange rate in the US? There's a bunch of broader issues that are bubbling away, as well as just the specific monetary policy ones.
No, I concur. Now, this is the last chart for the day. Now, I put this together last year, and it basically just shows what inflation would look like. Now, this is inflation by itself from household energy costs and rents. Now, obviously, the rental CPI component has been reduced slightly, so it needs to just be reduced by a bit. I need to update this when I have time, but it just goes to show that even under relatively benign scenarios, you are taking up most of the inflation target with just these few little components.
Yeah.
And as I mentioned earlier, I'd estimate that the low end scenario is around about sort of 1.75 to 1.8%. So I think that there really is that issue going forward, that we have this baked in inflation problem. And this is something that even Governor Lowe mentioned in the Senate estimates a few weeks ago, where he basically said that rental inflation in the CPI is going to remain high for, and I quote, a long time to come.
Absolutely right. And, the question is, are there offsettings that could, go negative, therefore some base effects maybe, but no, the structural problems we have here are writ large when you look at this chart.
Yeah, and I mean, like it's very difficult to foresee what will happen, more than a year from now. But in the short term, at least, say the next 12 months, I think that this shows nicely that too much inflation is baked in. But that doesn't necessarily mean that the RBA isn't going to do something silly, particularly if we get a new governor who is more pliable, shall we say, from a political perspective.
Yes, well, there's a significant political risk and economic risk from all of those things. And to what extent will the doctrine of inflation being the number one ghost to excise and just put interest rates up, very blunt instrument, will there become a narrative to say, well, we need to use other strategies too? And of course, Lowe was talking about productivity and other things. But at the moment, if you look around the world, Tarric, all those Western central banks are all pulling the interest rate lever and all following the same logic. So I'm not sure that swapping the governor will change the story.
No, not on a global basis. But even if we look at it solely through a domestic lens, even if somehow the next governor is politically coerced or politically motivated to be more dovish, take a more dovish approach,
yeah,
that is gonna, that's gonna really put the cat amongst the pigeons if everyone else around the world remains hawkish. Yeah. Now, that arguably should, in theory, make it a very unlikely scenario that they would be stupid enough to do that. But I'm not ruling that out because, well, that's, doing silly things is the rule of the day too often here in Australia. Absolutely, when it comes to policy. Well,
think of the political cycle. When is the next election? Think of all of the various pressures from various lobby groups. There's a lot of moving parts. We've pretty much done an hour. Is there a leading question that you just want to touch before we finish?
Good old Roger Brown, but bank customers, who is now unfortunately no longer with us, made the point that he said that he thought interest rates and the mortgage rates, I should say, will go to double digits.
Yeah.
Do you think inflation is sticky enough that comes to pass during this current business cycle?
Yeah, I mean, respect to Roger Brown, and go check he made a couple of shows with me. He was so prophetic in terms of, the underlying reasons as to why things were going where they were. I have a feeling that we're going to see the cash rate knocking on 4.5 to 5, because this inflation thing is going to go. I don't think we're going to see double-digit mortgage rates unless something else happens. But the consequences of moving from 0.1 to 4 or 4.5 or 5 is, as you said earlier on, Tarric, much more dramatic than when we had the last round in the 80s. So my own feeling is if it got to double figures, it would break the economy, it would break the banks, it would break the housing market. So it ain't going there.
Yeah, I mean, I tend to agree. I mean, like you might see double-digit rates in the sense that you might see some non-bank lenders for people with bad credit, and
so subprime, etc., etc.
Yeah.
I mean, there's already loans at 8 and 9% for some
Yeah.
subprime borrowers at the moment. So, but we're talking mainstream rates rather than
Yeah.
subprime rates. Yeah.
Yeah. Mainstream rates, no, I don't. Stuff will break. It will break long before we get there. I mean, realistically, despite all the hype, despite the housing market performing well, and all this sort of different stuff, at the end of the day, what we have now in terms of interest rates is enough to break the economy, and it's enough to break the housing market if it's given enough time. Now, the question is, will it be given enough time? And that is a question that's going to be up to the RBA and up to the global economy. And, like, if we do really start to see, some recession, some downturn, and then inflation comes down a little bit and the RBA says, well, we're going to cut rates or whatever, then, that's just going to depend on the circumstances. But to me, if you were to leave the current settings in place and even today's settings, and monetary policy can't be changed, and there's, no more magical funny money from the federal government, the housing market and the economy would be in serious trouble.
Yeah, and it's worth just reflecting. APRA and the Council of Financial Regulators underscored that they thought the 3% buffer was still appropriate. So that's the 3% buffer above the current mortgage rates, despite the fact that CBA is taking it down to 1% for some people. I think that's a really interesting observation. So they still have the view that there is an upside risk to rates, and they need to have that in there for financial stability purposes. So it's just worth reflecting on that in all of this conversation. Now, of course, they've been so effective. No, they haven't, in terms of managing this cycle. But nevertheless, I thought that was a really interesting stake in the ground that's come out very recently.
Yeah, I wonder how much of that is sort of political, in the sense that it's just like, well, look, we're doing our job now.
Yeah.
And especially with the banks mostly going their own way now and doing whatever the hell they want anyway.
Yeah.
But yeah, but I think the thing is that in all of this, people have been surprised. Like, you and I both talked about, rates rising to a much higher level than was predicted, 18 months ago.
Yes.
But I personally didn't think that rates would get as high as they have. Well and truly, good old bank customers was well and truly on the money on that. But can we rule out rates going even higher if, for some demographic reasons, or cultural or psychological reasons, people keep on spending, or there's another inflationary shock? I mean, maybe they have to take rates even higher and really break stuff to kill inflation, like the Bank of England has their problem now.
Well, to my mind, the real question will be the energy trajectory from this point. So if we have a really, really bad winter in the Northern Hemisphere, really cold winter, and there's a massive spike in demand for energy, and suddenly the energy futures goes through the roof again, that could definitely lead to higher rates. If we have the US not going into recession and the markets continuing to bubble higher, and the inflation still grinding higher, then they'll have to put rates up there. So, I mean, there are a number of explanations as to why rates could be higher. But I have the view that if they got to double figures, that would be, curtains for the current economic cycle, and a lot of people would be in really, really difficult situations. And like I said earlier on, the problem is, of course, that if you put rates up and then try and do things to support and help households and businesses, what you're doing is fighting against the monetary policy. So that means the rates have to go even higher. So maybe if the government does something, with some largesse, and, says, well, what we'll do is we'll actually support your mortgage repayments for the next 3 years or something like that. I mean, there's a bunch of things they could do, all of which could lead to higher rates. So it's not necessarily completely off, but my view is I think we're going to sort of knock around the sorts of numbers that we're at, or slightly higher, but it's going on for a lot longer. And it's that for longer problem, which I think is actually the real question now.
Yeah, I agree. I mean, honestly, even 1% ago was enough to really cause problems. That was, if you had that and you extrapolate that out over, say, 3 or 4 years, that would have broken stuff anyway, eventually.
Yeah.
But we've got a problem. We've got a fairly sizable problem, and I don't think that there is a very swift and easy way out of this from a domestic perspective.
Yeah.
And things are going to get more challenging.
Yeah, I fear that's the case. I suppose the only good news, Tarek, that will give us another reason to have another conversation in a couple of weeks. There'll be plenty to talk about, right? Because we're in the middle of this sort of cycle at the moment, which gives us never-ending data.
Well, it's funny. Our first show way back in 2019, almost 4 years ago, we
Yeah.
said, we live in interesting times, and that old Chinese curse has well and truly infected the entire world. So, things have been very interesting since, and I imagine they're going to remain that way for quite some
Yeah.
time.
No, well, Tara, thanks for that work on the charts and for your conversation today. And I really appreciate the chance to chat with you. I mean, we've tended to be calling it right so far, so maybe we'll continue that track, and we'll see you in a couple of weeks. Take care.
Yeah. Yeah, you too, mate. Looking forward to
Cheers.
it. Bye.
Bye bye.